Hello, this is Josh Belk with the Belk on Business podcast. On today's podcast, we're going to talk a little bit about internal controls in our either monthly or quarterly meetings. And this is kind of one of those areas that's not quite as interesting as some of what we talked about in the past when we dig into talking about KPIs or metrics in different phases of our business. And I'll pick up on some of those concepts in future podcasts. But on today, I'm gonna talk about and go beyond a little bit internal controls. A lot of these do talk about internal controls, and I think other different a couple different metrics that I haven't mentioned before or just mentioned briefly before that we want to take a look at periodically. As a business owner, many times we want to kind of focus on those areas or those larger dials that we feel that we can move as it relates to the growth of our business. We kind of think many times, how can I drive more revenue? And I think sometimes we need to dig in just a little bit deeper to make sure that we don't have issues within our company that may be resulting in some negative financial issues for us. And I'm not talking about blatant theft or other types of issues, although I'm going to talk a little bit about that in today's podcast. But I think really kind of digging into some of these areas will really kind of help us understand at a little bit of a deeper level what's going on in our companies. Many times as a visionary, and although I'm an accountant and I own an accounting firm, I hold a little bit more of a visionary's profile, and I think my team would tell you that. And so I'm not all that interested in digging in many times into the nitty-gritty details. So I rely on my own team, even though I own an accounting firm, to help me in these different areas. And when we talk about internal controls, a lot of times this is really kind of mentioned in sometimes in larger companies, or it relates to audited financial statements. But I think having some of these controls, even at a small company, even if there's just a few of you, that there may be some of this that needs to go on to really kind of protect your cash and to protect your business. And so I'm going to talk through just a little bit as far as areas that we need to be looking at I would say at minimum quarterly, and if you have a larger team, especially some of these especially you want to do on a monthly basis. First of all, we're going to talk about cash. And a lot of times, and I know I've mentioned this in prior podcast, we kind of see these T-shirts, and there's other people out there that are constantly talking about cash flow. And they're kind of focused on, hey, what is my cash flow? And if we don't hold this particular term in the right context, just the term cash flow is meaningless. We can generate cash flow from taking on additional debt, can increase the cash in my bank account. So we want to make sure it's the right type of cash flow. But when I talk about here about looking at our cash, I'm going to kind of talk about this in the context of internal controls. Are the internal controls as it relates to my cash, are they being followed? Was the money going out the door, was it approved in the proper manner? We don't want to give ever too much control to one person, meaning we don't want the same person that's going through and collecting the money from our customers, depositing the money, doing the bank reconciliation, writing the checks, and generating the financial statements or the monthly statements for the owner. We don't want one person sitting in all of those seats. Regardless of how small your company is, you should not give that much control to a bookkeeper, to a controller, to our finance person in our business. There does need to be somebody else involved. If you're a really small company, it might be you as the owner. So if there is some sort of a spend, now in my company here, there's not that many of us. Still, we've been growing a lot this year, but we're still a pretty small company. However, now when it comes to most of the things that are bought, even as the owner, I don't do the buying, I don't do the bank reconciliations, I don't do everything as it relates to cash. I do have other team members that are involved in the process. So they kind of help me make sure that everything's being done appropriately, and then also in the alternative that I'm making sure that that everything that we're doing, that our spend is being done in a proper manner. So you're going to have more than one person, ideally 2 or 3 people that are involved in the process. So a person determines, okay, we need to purchase this. That order gets put in. Somebody signs off on it. It gets approved, and then a different person altogether is doing the bank reconciliation. So you don't have the same person that's doing the spending also doing your bank recons. So as you as the business owner, on occasion, need to be involved with your finance people. Now, if you're in a larger corporation, you might have a CFO that's doing this, but even you as a CEO of your company still needs to be involved on an occasion taking a look at these reports. And it's probably not a bad idea for you on occasion to pick up your bank reconciliation, to get that your bank reconciliation worksheets from your bookkeeper, get the bank statements from him or her, and take a look at it. Do these things make sense? The transactions on the bank statement, do these make sense? So once again, you as a business owner being involved on occasion, no one person should have unilateral control over cash. Another area when it relates to cash is looking at is there a cash overage or a cash shortage as it relates to your business projections. And so you really should have a really good idea of how much cash you need on hand. What is the regular amount of cash that you have on hand? If there's a lot more cash in the bank, but we need to find out why. If it means that your sales are going up, that's a good thing. If you end up with cash being below where it should be, however, it seems like your revenue numbers are correct, and you really need to start to dig in a little bit more on why is there more cash in the bank, or in the alternative, why is there a lot less cash in the bank than what we were projecting there to be. And review your spend on the balance sheet as well. So going beyond just the profit and loss, these direct expenses, but also looking at the balance sheet as well. And let me give you just a kind of a practical example. So if you see that you're kind of looking at maybe a comparative balance sheet, and you see your furniture and fixtures going up, meaning maybe there were some computers bought, taking a look at those transactions, maybe even taking a step deeper, that somewhere in your business there was an approval for 2 computers to be purchased. But verifying that against what was actually purchased. Were there 3 computers actually purchased? And if that's the case, where is that third computer? Is it on site somewhere? Did an employee take it home? So you can get a little bit creative, I guess mentally, as it regards to what direction that this can go. But sometimes it's just, especially as your company grows, it can be those little things that can create a leak in your company. So just making sure that everything is being done correctly. That somebody's approving the spend, that somebody's verifying it, that a different person's doing a reconciliation, and then periodically there's somebody at a higher level that's kind of just asking questions, not to be annoying or not to create a culture of distrust, but really to create a culture of verifying the numbers, to protect. And it's really kind of one of those things. It's not just protecting the owner and protecting the cash, but really protecting the business as a whole and protecting the employees as well as it relates to their employment. So first of all, periodically digging into the internal controls as it relates to cash. Now, you may have a type of business saying, Josh, I don't have any internal controls at all in my business. I would encourage you maybe to look in this a little bit deeper and figuring out what sort of processes can I put in place. Nothing crazy. Maybe one of those things that you lean on your outside accountant just to come in periodically to take a look at things to kind of help you. Maybe it's your company small where you don't have somebody internally that can do this for you. Secondly, take a look at your inventory. For a lot of our clients, they're in real estate, so their inventory might be their projects in process. We have, for example, just across the street over here, one of our clients, they're a produce company. So people come in and they buy produce and they take it home with them. So different types of businesses, but the concept is still the same. What sort of controls do you have as it relates to your inventory? When we talk about real estate, when you go through and you budgeted for rehab on a project, is that process being managed? Is that project being managed well? If you're more in the retail space, whether we're talking produce, whether you're selling shirts and pants, making sure that that inventory is being managed and is being managed well. So is there a proper approval process as far as what is being purchased and what is being brought in? Is there controls as far as once the item is there, making sure that it gets put on the shelf, making sure that it is being recorded correctly? If you're dealing in a situation where maybe sometimes inventory it becomes obsolete, there's a process, there's a decision-making process for determining whether or not an item is obsolete, and then how is that being recorded. Once again, we want to make sure that there isn't inventory going out the door with employees. We want to make sure that that inventory is being managed well as it relates to the amount of money that we're spending on a project, making sure that we have good budgets, those budgets are being followed, that there is that dialogue when there is going to be the possibility of a budget overrun on a project, that conversation is being had earlier on than later on in the process. So making sure that we have good internal controls and good processes as it relates to our inventory. Next, to review your collection cycle. And this really specifically as it relates to your accounts receivable. Taking a look at your accounts receivable balances, making sure this is you're reviewing your accounts receivable. Is your collection cycle improving or is it lengthening? I know here in my particular business, this is one thing that I look at quite often is inventory. Is our accounts receivable balances. And when that number starts to get a little bit higher, I have one of my team members that comes in and says, "Hey, Josh, our inventory is getting a little bit high." And then I may appoint a team member. We need to start calling people. Okay, because that cash conversion cycle is extremely important to us. We want to make sure that money is coming in the door, that we're able to keep our business growing. Because right now we are very much in a scaling phase and scaling quickly. So cash is extremely important to us right now while we're in this particular phase. So accounts receivable is important. So who's looking at that? You as the business owner should be looking at it. And looking at your accounts receivable. This is going to tell us a few things. Is our cash cycle, is it improving, or is it getting worse? Is it taking me longer to get my cash? Beyond that, I think it can tell us some other things. I know in my particular business, as it does in many of our clients' business, it can tell us whether or not we have the right customers. And so this can be an indicator of whether or not there's something wrong on the sales side. So when we're going through and we're in the process of selling our product or selling our service, are they clear as to the process as far as collection of payment? This can tell us, is there something wrong in the sales process, or are we selling to the wrong clients? Have we onboarded the wrong clients? We can go out and we have a great sales process, and we're bringing those clients on. But once we bring them on, I would say a great sales process to the ability of being able to sell, but poor in the area of being able to define whether or not the right clients. We can go through and we may do a great job of selling the Mercedes, but guess what? The person that wants to buy that Mercedes can't afford a Mercedes. Okay, they can only afford I don't know what a low-end car is. Maybe they can only afford a Toyota, okay, or a Chevy. And so we're trying to sell them a 7 Series. I drive a BMW, so so maybe we're trying to sell them a 7 Series, but really all they can afford is a 3 Series. So we go through and we sell them that car. However, we find out that we have to go through and we have to repossess it, or we have to turn it over for collections, or we just find out that this client just simply can't pay us, and we're gonna end up kind of in trouble financially in the long term if we continue this cycle. So are we really selling to the right clients? Are we onboarding the right clients? And then maybe we have onboarded clients well, but maybe some of them are just simply neglecting to pay their bill, and maybe we need to make the determination of turning them over to collections. Next, reviewing our debt, both our short-term and our long-term debt. Reviewing credit card balances, our lines of credit, as well as long-term debt, making sure that we're paying our debts, that they're being paid timely, and then also if our lines of credit are going up, why? Was this approved? Making sure that we're taking a look at our short-term and long-term debt, making sure that debt is being managed well. If our numbers are increasing, if our credit card balances are going up, if our lines of credit are going up, making sure that we're asking the question of why. Why is our debt position getting worse? And if we're in a scaling phase of our business, maybe we're taking on debt to invest. That could be a good explanation. If going back to accounts receivable, customers aren't paying, so now we have to go to the bank to borrow more cash. These are things that we need to understand. If we're just looking at the profit and loss, we may not see that. To making sure that we're looking at our balance sheet and analyzing both our short-term and our long-term debt, it can tell us a lot about what's going on in our business. Next, reviewing our other liabilities, especially as it relates to payroll and sales tax. Okay, so we want to make sure that we're compliant there. Has our sales tax been paid? Have our payroll taxes been paid? For a lot of smaller businesses, when they go through and they begin hiring people, this is one area they can really get themselves in trouble very quickly, and eventually it really can put them out of business. And it's one of those areas that you just can't file bankruptcy and walk away from, especially when it comes to payroll taxes. So you want to make sure as a business owner that if you have payroll taxes, make sure that those are getting paid, because that is one type of a tax that can pierce through that company veil and will end up on you personally. You're not going to be able to walk away from. So make sure that those liabilities are being addressed. Next, making sure that you're confirming transactions that may be out there that are of a personal nature. And so this will go through into a business where maybe there's multiple owners, or maybe you're in a business to where maybe you're part of that executive team, and the business owner is spending a lot of the business cash, and it's not getting run through payroll. Making sure that's getting classified correctly, and also to make sure that if there is an issue, that you're aware of it. So it may be one of those issues that we're gonna set the the owner set his pay as $36,000, but he's taking $100,000 out of the business. It can really also create a compliance issue. So making sure that you have an understanding of what's going on, make sure transactions are being booked correctly, but beyond that, just to make sure from a compliance end that that is being followed. Really, when it comes to distributions out of a company, there are steps that are supposed to be taken as it relates to the proper meetings, a discussion, a determination of there being a distribution out of the company, not the owner going through and using the business checkbook as his or own personal checkbook. And make sure that there is a control as to what is the process for the owner taking money out of the business, and that process is being followed. Next, reviewing recurring expenses. When I talk about this, in a couple different areas. First of all, reviewing the recurring expenses for identification, and maybe there's a contract that's come up. Making sure that all of your recurring bills are getting paid, such as your rent, your utilities, etc. But also maybe there's opportunities there. We had a client actually, and weren't involved with them in this process, but I remember hearing them tell me one time that they just went through and just reviewed their dues and subscriptions. And they saw all these recurring automated transactions going out the door, and it was costing them thousands of dollars a month in these subscriptions, things they signed up for, and they never just stopped subscribing. And so they just kind of automatically come out of the checkbook. So be reviewing these recurring expenses on occasion to see what can be cut back, making sure that we have the right vendors. Insurance, for example, these are one of these things that comes up annually, and sometimes insurance can end up just really biting us in the rear end, so to speak, because we end up with this massive increase. Maybe it's workers' comp or general liability, one of those areas that we need to be aware of. This may be something that we need to shop around and see if we can find a cheaper alternative to be able to save us money, and that will help increase the bottom line immediately. Next, we're reviewing your gross margin. So a material fluctuation in gross margin may be an indication of miscategorization of expenses or flaws, once again, going back to inventory management. So what is our gross margin? What is that percentage? If we see a large fluctuation, especially if we see that gross margin decreasing, it may be a sign that there are some other problems in the business that we need to take a look at. And then lastly, for today, our customer acquisition cost. This is one area that I think a lot of business owners really don't know what their acquisition cost is, but it is one of those areas that can be an indicator on how well your business is doing. So making sure you're reviewing your customer acquisition cost. What is it costing us to acquire a customer? And if that number is improving, good. It means that our marketing may be effective. It may mean our sales process is improving. If our customer acquisition cost is increasing dramatically, it can mean a few different things. First thing we want to take a look at is our marketing spend. Are we spending our marketing dollars the right way? And then we also want to look at our sales process. Is our sales process, is it good? Are there some areas that we need to improve? Are we identifying the right customers, et cetera? And then also this could be an indicator of some market fluctuations, and we need to be aware of those as well, and making sure that we're moving forward in the right way. And our customer acquisition cost, making sure that we know what that is, really can help us as far as identify either opportunities or problems in our business. So just a few different areas that we want to be taking a look at, some of them as it relates to internal controls, some as it relates to marketing and sales, etc. Once again, this is Josh Belk with the Belk on Business podcast. I appreciate you listening today. If you found this particular podcast of some help to you, please consider subscribing. Thank you. Have a wonderful day.